The Newbie Real Estate Investor Podcast. I'm Jonathan Boyle with my co-host Joey Chan. Joey Chan, and today we have a special guest, Aaron Fragnito. Welcome to the show.
Thank you, gentlemen. Thank you for having me today. Glad to be here.
Welcome, Aaron. So, hey, Aaron, want to just start off with asking you a few quick questions. What were you doing before you got into real estate? And then bridge that into how did you get into real estate?
Okay, well, before I got into real estate, I was a ski instructor in Steamboat Springs, Colorado, living my best life, skiing the Rockies day in and day out, getting paid to do it. And you'd say, well, why would you then move back to New Jersey and work 60 hours a week running a real estate investment company? It's because of passion, Joey. Passion. I'll tell you, I read Rich Dad Poor Dad in college. My dad owned a condo in a big development. When I was a kid, we would go there and turn it over. And, I always had a passion for real estate, but I didn't really recognize it. I had a painting business in the past. I had a landscaping business. I went to Rowan University. I got an entrepreneurial degree, a business degree in entrepreneurship. That was pretty cool. And I learned what a franchise was, and I learned how to work hard and show up on time. I learned what a debit and a credit was, but I just didn't really know what I want to do with my life. And I remember my college advisor said I should sell insurance, and I got really depressed because I have no passion for insurance. And I went out to Colorado and ski instructor for 6 months, and I read all these other books about real estate investing and went on LoopNet and started learning about how people buy these big commercial buildings. And they made it sound all so easy, and all you need to do is just raise a little money and bada bing, bada boom, you have yourself an apartment building. So 10 years later, I'm an overnight success,
Yes. So how did you actually get into real estate? Tell us a little bit about the first deal you actually did.
Sure. So I came back home from Colorado, 2010. I got my real estate license. Okay. I became a realtor. I said, okay, here's my goal, right? I wrote it down and I said, in 10 years, I want to have a net worth of $1 million. I want to have a passive cash flow from my properties of $100,000 a year. And I said, okay, how am I going to get there? So I made a list. I kind of worked my way down from that goal. And I need to make connections, meet people, raise capital, learn how the business works. And okay, a good place to get started is being a realtor, because I had no money either. I need to make some money. So I got my realtor's license. I sold one house in 6 months. My broker took 90% of the commission and said, read the fine print. So I made $500 in commissions in 6 months, and I was about to quit. It was a terrible market. It was a terrible broker, but I learned short sales, and I learned how to do those and how to work with bank-owned properties. And I started meeting a lot of investors who loved me and how I got all these great deals for them through short sales and REO properties. And what I did was I used some of those relationships with those investors. And I said, why don't you try investing in me and with me in a property? And eventually I did actually get into my first flip. Okay. My first flip was a partner I met at a real estate networking event. And he had owned a business coaching business. And that business had just filed bankruptcy. So I guess he wasn't great at business coaching. And I decided to team up with this guy. And I convinced my father to invest about $200,000 in a fix and flip in Mine Hill. I remember we hired contractors that didn't pay the subcontractors. So our general contractor didn't pay the subcontractors. So the subcontractors snuck back into the house and stole the copper piping they installed because they didn't get paid. So the job was a mess. My partner, who I ended up teaming up with, ended up stealing money from the account, acknowledging it and just saying, well, he's working hard and he should get an extra icing on the cake. It didn't make any sense. So we got rid of him, quick claim the deed, got him right out of there, and just said, we're going to double down and get this done. And we did. We hired better contractors. My father was able to salvage most of his investment. We only lost $7,000. And since then, my father's made a lot of returns on his investments. So, nothing wrong with friends and family to get started. And it was a really tough flip. Yeah. Mm-hmm.
Yeah, no, that's incredible. I mean, so Aaron, just to, I guess, emphasize this. So then your first flip, you didn't make hundreds of thousands of dollars.
No, I lost $7,000, but people pay like $25,000 for coaching packages. So it was the best coaching I ever had,
Exactly. No, I just wanted to emphasize that for the audience, because some people think that, you can't lose money in a deal when realistically you could lose a lot. And just losing 7,000, even, like when you get started, most would be disheartened and be like, oh, this doesn't work, I quit. But you didn't. And you actually thought of it as like your education. Because like that's the way I see it. Like if I lost money, it's way cheaper than if I went to college. Like I've mentioned it several times. Like I went to Columbia. I would have never went there if I didn't have the GI Bill, because that was like almost $100,000 a year. So it's all perspective.
Right. I had a $80,000 degree, coming out of when I was 22 years old. And boy, like it just, I didn't feel prepared at all for the real world, and when I finally started doing deals, and many of them did work out, but the ones that didn't work out, I've learned so much from, more than the successes, for sure.
Yeah, you definitely learn more from the failures than your success. Chronologically, what was your next, set of deals? Like, what did you do? What was your
first strategy?
So, all right. So I did want to flip houses. I did want to learn how to flip houses the right way. I knew it was a matter of having the right partners, but I also knew my weaknesses, right? I'm not great at necessarily managing construction sites or dealing with contractors. I'm more on the sales and marketing end. I'm good at raising capital and working with investors and structuring the deals in ways that make sense to our investors and to us and our other parties involved. So I teamed up with Seth Martinez, who's my business partner to this day. And I met Seth because I was his realtor, right? I was in the business working with these people. So I met a lot of different investors, and, some I got along with, others not so much, but Seth Martinez was a great fit and his goals aligned with my goals. And we wanted to acquire 1,000 units in the next 3 years. And we bought a 6-family together from a We Buy Houses signs. I used to staple on those telephone poles, and that used to work really well back in 2012 or so. So we bought a 6-family together for $220,000. We raised a little bit of capital. We put in a little bit of capital myself. I finally had about $20,000 saved up by then from commissions. I learned how to sell short sales and was making a little dough as a realtor. So I put in some money, but most of the money came from other investors. And Seth had sold a medical billing company, so he was liquid. And he was great at the management end of the business, analyzing deals, sourcing deals, and the operations end, dealing with contractors. And I'm great at customer management, dealing with investors, marketing, branding. So we really jived there. We realized that we bought the 6-family, bought it for $220,000. We put probably another $80,000 into it, maybe not even that much, and it appraised for a much higher amount, somewhere in the around $500,000 or so. So we were able to refinance our initial investment back out, plus additional capital. So our investors were very happy. They did very well. We did very well. And we recycled that refinance capital into more deals. And we got up to about 100 units over 3 years. And we realized you need quality over quantity to make money in this business. You can't just buy everything that looks good on paper. And we developed our own management company and kind of hit the brakes and got rid of properties that weren't making money. And now we're focused on quality over quantity with our holdings.
And when did you kind of get into the whole, because I know you do quite a bit of wholesaling, right? When did you get into that whole business?
Sure. Well, wholesaling, I kind of started as a wholesaler. I basically, one of the first things I did in 2010 when I was getting my realtor's license, which was a good move. And if you're getting started in real estate, getting a realtor's license was a great way to get a title, have a certificate, have a reason to be in the deal, a way to make money, a way to be moving real estate and meeting players in the business. So it's a great way to get started. But I was also wholesaling. Right. And I was putting up those signs and, talk to your broker about this. But basically what I would do is someone would call and they'd be like, all right, here's the deal. Da, da, da. If it was a major fixer upper and needed a lot of work and they're willing to take an investor friendly price for it, I would just connect them with an investor and I would make a wholesale fee. Okay. Because I was procuring these leads with my own investment and my own marketing.
Yeah.
Sometimes I'd even raise the capital and buy the deal once I had those resources in place. But getting started, I would give the owner of the property an option for me to wholesale their property if it was wholesale friendly, meaning it needed work and it was a good price. Or if it was more like a retail property and they wanted full price for the property, I'd be, okay, it's better if I list it as a listing agent, put it on the open market, and sell it as a realtor. And I'd have my realtor hat on. Okay. Now, listen, you got to know what you're doing to do that. You cannot come in as a wholesaler and tell someone his property is worth X and be like, I'm a realtor, I can value your property. That's a big red flag. You're either, going to start the relationship, as a realtor, or you're going to, do the real relationship as a wholesaler. The difference is a listing agent has your fiduciary responsibility in mind, and your goal is to get the highest possible price for the property as a listing agent. So you have to be very clear. If you're going to be doing that, you cannot be wholesaling it, which is really the opposite, where you're actually trying to get the seller to agree to the lowest price possible so you can then wholesale it and flip the contract for the highest price possible to make a profit in the middle. Now, there's benefits to wholesaling, of course. You don't have a ton of showings, and it could be an as-is contract and things like that. But you gotta understand who you're working for in these scenarios. But that's what I would do. I would either wholesale it and make a quick buck there, or I'd list it, make money there through my brokerage, my broker. And I got a lot of listings that way. I got a lot of short sales, a lot of other listings. So
nice.
Yeah, no, that makes perfect sense, because I know I'm a realtor as well, and I have to always disclose, in writing and in person, look, I'm not whenever I'm talking to homeowners, look, I'm working as a wholesaler here. I don't have any fiduciary responsibility as a wholesaler, but if you wanted to go into the open market, I can help you with that as well.
And a lot of the owners like those options, and I know there's a lot of realtors out there that might listen to this podcast and say that's illegal or that's unethical. But as long as you have transparency and communication, a lot of people are like, wait a minute, you can give me $100,000 in cash and close in 30 days. And you're, just going to buy the property, or one of your investors, your network's going to buy it. And they might like that a lot more as is. Otherwise, a listing agent, I might say, listen, I can list it for $129,000. I'll take my 6%. The buyer's going to nickel and dime you down another 15. It's going to take 6 months to get it all closed. You're going to have holding costs, and you're probably going to end up roughly with the same amount, but maybe with more headaches. Depending on the property, wholesaling was a better option. Now today, I don't know. It's hard. The market's so hot. You put something on the MLS, the phone blows up if it's the right price. So it'd be a pretty hard argument to say, let me wholesale. That's why wholesaling is so hard right now. It's difficult. Yeah.
Yeah, it's definitely got to be the right property. It's got to be something where it needs a ton of work, for instance, things like that. If it's a decent, property, it's gonna fly off the shelf right now.
Yeah, no, it's funny because one of my friends, her parents were going through a divorce, and she said that, hey, can you buy my house from them? And I looked up, I walked to them, I talked to them, I told them my number, and I told them up front, look, you could get it up, you could get more on the market if you want. I could list it for you, and we could sell it. And of course, they went that way, and now I'm going through several other issues, but Jerry knows about it. But yeah, you always want to, it's like a good option you could give people. If you could tell they're not really interested in a wholesale fee, or in wholesaling the prop, or you wholesaling the property.
Right. A lot of people like the idea of, okay, this is what I'm going to get. Great. I'm going to get it at this time. Great. When you list a property for sale, there's no guarantees. And, with the holding costs and the buyer's punch list and the realtor commission, you might end up at the same spot anyway. And, there was a time too when the market was not good, right? It was a buyer's market. So the wholesale pitch was pretty attractive. A lot of times you'd list a home and the phone would not ring, and that was a different market. So that was a great time. There was also the auctions, the sheriff sale auctions, which might be your next question here. Basically that was what we evolved into. We started with bandit signs, right? And that was good. And we made some money there. But then we really hit our stride around 2015 to 2017 with the sheriff sale auctions. And boy, were we in the right place, the right time. We would walk in there on a Tuesday afternoon and with $100,000 in cash, scoop up 3 properties, flip them, double the $100,000 within 30 days. Those were years. I remember one year we made $1 million in wholesale fees. We did 60 transactions, and the game has changed now, though.
Yeah, for sure. Yeah, I remember bidding against you guys at the auction in 2018.
Oh yeah, it got crazy by 2018. There was people would go there and they'd be like, yeah, I went to a guru course last week, and I have $50,000 to invest. 25 of it went to the guru course, and now my other 25 is here at the auctions. How does this work again? it's a tough. It's really, the pinnacle of investing. If you're new to investing, it's a risky way to get started, in my opinion.
What made you pivot from, wholesaling direct from homeowners to the auction?
Well, we would continue to do private marketing to find sellers there. Quite frankly, it was just the path of least resistance to find deals. We'll spend now up to $7,000 in direct mail marketing to source one good deal that makes us $15,000 to $30,000 in profit. So that's not bad, but the amount of work that goes into sourcing those leads, looking at those leads, figuring out what's good, what's not. A lot of the stuff you're dealing with in the open market are like difficult sellers where you kind of dig into it and you realize why the home is not sold. You realize why it's going for that price because they maybe aren't cooperative, and it's frustrating. So those transactions, right? You'll sign a contract with a homeowner and then, 3 weeks in, they'll say their sister's going to buy it instead. What are you really going to do? Sue some old man or something for not selling their home? No, you just got to roll with it. So, and that happens with private ownership. So that that's frustrating. Where the auction, I kind of like it. It's cut and dry. It's business. It's business to business sales. We know what we're getting. If there's $3 or $4 grand and extra taxes or backwater and sewer on title, man, we would just figure that in. Every time we bid on a property, we assumed there was $4 grand of stuff we just didn't know about yet on title. And that's usually how it panned out, and 9 out of 10 deals were very profitable. And there was always a couple lemons there. And we figured out how to get most of our deposit back through, hiring the right attorney. So, man, I missed the auctions. Those were great days.
Yeah. So it's about what your latest, I guess, iteration of your business is. Now you're more focused on raising capital, doing apartment complexes, things like that. Yeah. How did you more or less get into that, shifting from, I guess, the whole wholesaling business?
Sure. So Seth and I bought that 6-family. We did very well on it. Then we recycled that and got more 2s and 3s and 6s. We bought a 25 unit eventually, and we sold that. We made a ton of mistakes, but on the 25 unit, but we made a great profit. And we said, wait a minute, all units under one roof, the easier it is to make money. And business is all about finding the pathway of least resistance and then doubling down on that pathway. And not going against the grain, not going against the economy. So, we recognize that it's a lot easier to make money with more units under one roof. Generally now we don't buy anything that's less than 10 units because quite frankly, it's difficult to cash flow on a 2 or 3 family property. You can, it's a great way to get started. You should start with a 2 to 6 unit property because I don't agree that jumping into like a 70 unit is smart. I mean, unless you can source that capital, I'd be very impressed on your first deal. But essentially, you want to start a little small with real estate. But once you get your feet wet and have your resources in place, you do want to get into bigger units. Bigger is better. So now we raise capital to buy 10 to 50 unit buildings. And we have a management company in-house. And we still flip properties, we still wholesale properties. But that's gotten so difficult to source a deal. Our cost of the deal has risen so much and our profit margin has not risen that you just have to look at the writing on the wall. Mm-hmm. And around 2019, we said, well, our wholesale business went from making $1 million a year to maybe 400,000, but the amount of work we're putting in is the same. The amount of investment we're putting in is roughly the same. So the return on time and investment was weaker and weaker now. So we said, wait a minute, look at our apartment buildings. They're going very well. Interest rates are low. Rents are high. We have sources of being able to get off-market deals from worn out landlords or good brokers or wholesalers we've made friends with through the years. So we can source discounted, distressed apartment buildings, improve them with our in-house management company, and refinance them or sell them for larger profits than we would ever make on a single family home or even a 2 or 3 family. And we said it's almost the same amount of work to do it to a 3 family as it is a 25 unit. The only difference is you need about $2 or $3 million more. And that's where I've really tried to perfect my craft, which is raising private capital.
I get your emails all the time. You have a webinar. You can log in and kind of.
You do a lot of them on LinkedIn, I noticed.
Yeah.
Yeah, we have lots of different different things going on. And we do a webinar 3 times a month. We do a live webinar, and we used to do those in our office, but we'll start those up again soon in Berkeley Heights again. Yeah. Mm-hmm.
Nice. So I guess just for the audience who may want to eventually get into apartment complexes and whatnot, how did you start raising capital exactly?
So let's rewind back to, being a realtor, making those connections, working with investors and showing them integrity, just communicating with them well, bringing them great deals, being someone that, is fun to do business with and trustworthy. And eventually, and I got to say, a lot of my investors didn't like it when I started buying property, but that's how it went, because they wanted me to be the realtor, the deal source. And I said, well, I'm going to start cherry picking the best deals that make the most sense to me and raising capital for it. And I already had the trust of people buying real estate, and most people buying real estate have a lot of capital. Most use those relationships and that trust to then, explain the opportunities to them, give them equity. I had to give away a lot of the pie in the beginning, a lot of the ownership to make it fair for the investors for their level of risk. And I paid interest rates of like 18%. I would do a promissory note and borrow an investor's capital at 18% interest and work that into the deal. That might be my equity in on a deal, right? And then I would, which you get, it's don't necessarily do what I did. I would, if you're following me here, right? So I would say, okay, here's a deal, right? And I'll be like, I'll bring in $20,000, right? Well, when you bring in $20,000, it doesn't mean you have to go out and dig ditches to make that $20,000. You can have a relationship with a private investor who's going to give you a promissory note, an IOU, for that $30,000, and maybe you're paying them 18%. I would try to get that down if I were you, but that's where it started to get started in this business, and that would be my money down. And now all of a sudden I had $30,000 down. And if you're talking to an investor, you're trying to build a relationship, this might be your first deal. Well, having 30 grand is a very different conversation. Now they know you have some skin in the game. So I would raise capital using promissory notes to give me some cash to have my skin in the game, to then bring in other equity partners that would bring in the rest of the cash I needed for the down payment. And I would then leverage all that capital with a hard money loan of some type, and then I would refinance out of the building as quickly as possible. Sometimes we would buy properties with just regular conventional loans. That's pretty much how I did it. So just to reiterate, if you're following me here, I would have a relationship with a real estate investor, and I would say, hey, let me borrow $30,000. Some of them would only want to do promissory notes, only want to make interest rates. So I say, okay, fine. I'll sign the promissory note, I'll personally guarantee it, and I'll pay you an interest check every month. Boom. Now I had 30 grand. And then I would go to the next investor. I'd say, hey, Mr. Investor, you wanted to come in with me on this deal, but you said since it's my first deal, I needed to put in money. So here's the money. I put down 30, you put down 30. We're going to split up the equity in a fair way. I'm not going to pay you an interest rate because you're an equity investor, but the property is going to cash flow. When I refinance, you can get back most of your investment. And you can kind of structure it however you need to there. So that way I'm not paying 2 investors an interest rate. I'm only paying 1 investor an interest check. That is a high risk loan I'm taking on, but I'm using that cash not to go on vacation, but to invest in an asset that made cash flow beyond what I needed to cover for that interest payment. So I would still make money on that money. And now the other investor who wanted me to have skin in the game would then be confident to put in his investment to give me the full amount of money I needed to buy the property, renovate it, and either refinance or sell it, whatever the exit strategy was. That's how I did deals with no money down.
That's pretty awesome.
Nice. So was that kind of similar to for apartment buildings, or was that strictly for like flips, or?
So when I got into bigger buildings, our first building, we had 4 investors come in with $100,000 each, and another investor at $50,000. We gave them equity ownership. We gave them about 60% ownership of the building, and then we got a conventional loan for the remainder of the money. My partner and I did the operations. We developed our management company through that time. There had a lot of challenges with that, and then we sold the building for a profit about 2.5 years later. And our investors made about a 10% cash on cash return annualized on their money. So they were happy. We did better than projected. And we made a lot of mistakes, and we still came out very nicely on it. We said, oh, okay, well, wait a minute. Then these are actually more forgiving than the 2s and the 3s on, where if you make a mistake there, you can be, stuck. So, we found that they were easier to do in a sense.
That makes sense.
Yeah.
Guys, unfortunately, a train is coming by. It's going to get a little loud here. Do you want me just to mute real quick? I bought a home on a scenic train line. Okay, I'm a big train guy. I love trains. So it's a scenic train line. Now, a few months after I bought it, it also became a train line for moving freight. That's okay. It comes by twice a day, but sometimes you get a little train line. So it's a beautiful little area. It can be a little loud at 2 times the day.
That was quick though. I expected it to be much longer.
I got a great price on the home because of it, and a ton of equity in it. So it was a great deal, man. I couldn't resist.
Yeah. And you know how to find deals, so that's
look along the train lines. There you go. To get the train line discount.
Funny thing, I actually found a deal for my parents to buy that is along a train line. Now the train line doesn't actually work anymore, but yeah, it's like it's right across the street is the train, like the railroad tracks.
It can be a kind of a scenic thing. I think any commuter lines are going to be a pain in the neck. But like if you're like this line is literally, I'm actually up in Vermont right now. This is actually along, a train line that people pay money to go ride and see the foliage this time of year. It's actually a lot of fun. It's cool. You get like dinner on the train. They do like shows and stuff. So, it's through this valley, like the ski valley here in southern Vermont. So
that's cool.
Oh, wow. That's different.
So basically, I was explaining, how I did the first 25 unit there. But yeah, I mean, even just getting started, I used those relationships, and those investors on the first 25 unit were people I had met. Seth knew people and I knew people. See, that was it too. I met Seth, and that's when my career really took off, because all of a sudden, all the things I wasn't that great at, managing the properties and contractors and analyzing things really, really in depth, saving money right and left, he took care of all the nitty gritty analytics of it. And that gave me the time to go out and raise more capital, and build that brand, because it's a full-time gig doing the podcasts, and the webinars, and the marketing and everything. Yeah.
Yeah, we have an idea. Where can people find you on social media?
Sure. So our website is peoplescapitalgroup.com, and our Facebook group is called Real Estate Investments on Facebook. And we have a YouTube channel, People's Capital Group on YouTube. We also have the Passive Cash Flow podcast, which is on all your major podcast platforms there. And on our website, peoplescapitalgroup.com, you can check out our podcast and our other videos, and even fill out the qualification form to qualify to invest passively if you feel like that meets your investment criteria. And but yeah, we have a lot of information there. There's even recordings of our webinars on our website, peoplescapitalgroup.com, that people can watch, learn how we reposition apartment buildings. The thing is, man, we're getting into short-term rentals here in southern Vermont. So I'm up here spearheading this next part of our business, and it's looking very lucrative. It's already been very lucrative for our passive investors. So this is fully funded right now, the new short-term rentals in southern Vermont, but it's something we'll probably be opening up down the road to new investors. But for now, we are buying a 25 unit also in Patterson. So we are opening that up to qualified investors. And to learn more about that, you go to peoplescapitalgroup.com and fill out the form to invest. Yeah, you better cut me off, because I have like 24 more stories I can tell you about things.
We'll leave that for another episode or two.
There you go. That's a good plan, my friend. Good plan.
Thanks, Aaron, for being on the show. And take care, everyone.
Thank you.
Thank you, guys.